Yes, good morning folks. This is our weekly gold bulletin. Today is the 4th of November 2008. My name is John Needham. As usual, I will be your host. Before we start to look at the gold and silver markets, let me just remind you that today is US presidential election day. I suggest that you're very, very cautious with your trading. The elections themselves should not have any effect on markets, but any public events seem to be enough to bring the crazies out, and it's a great excuse for short-term traders to be hitting your stops. So my suggestion is you treat it as if it were a Fed interest day and expect the same sort of ruckus. Markets generally have been very quiet and subdued for the last 2 days. Perhaps participants are waiting on the results of the election, although it will be far more important when we start getting some policy after it. But just be very cautious, because we have very small ranges on the charts and it will be easy for short-term traders to knock out stocks. Okay, let's start with our usual look at the gold markets, and as usual we go from the long-term chart to the short-term chart. So our first chart to look at today, as usual, is the binomial chart, the binomial trend chart that we use to establish our trading signals. In the longer term, the first one is the COMEX Gold monthly chart. You'll see from this chart that the monthly chart remains on its sell signal. The monthly sell failure point has not moved and is still at 934.70. That means that a monthly close above 934.70 is required to void the current monthly sell signal. We move on then to the COMEX Gold weekly chart, and you'll see that last week returned an inside bar. That is the high of the day, of the week rather, and the low of the week. We had a lower high than the previous week and a higher low than the previous week. The whole of last week's price action on the weekly chart was contained within the previous bar, or inside the previous bar. That's why it's called an inside bar. And that tells us nothing other than that there is a lack of momentum and a lack of direction in that market. But we have the gold monthly chart remaining on its sell signal, which it has done since March, and the weekly chart remaining also on its sell signal. It would now require a weekly close above 816.30 to void the existing sell signal. We then look at the Huey chart. As I've said to you before, many traders and analysts like to see confirmation in the Huey index, which is the index of selected unhedged mining stocks that produce gold and silver but don't hedge the price of their production. The theory being that if it's a bona fide move, a sustainable move in the price of the metals produced, that will be reflected in the stocks that are the major unhedged miners. So one would expect to see, logically, confirmation of any signals generated in gold or silver, the primary markets. You would expect to see that confirmed in the Huey. And in fact, Huey's been remarkably consistent. It too has remained on its sell signal since March, and you'll see from the monthly chart, which is available free at the Danielcode website, www.thedanielcode.com, where these charts are posted every Monday, and the weekly gold video bulletin is posted on Tuesday. You'll see that from the monthly chart, Huey has remained on its sell signal quite consistently since the March high, which the Danielcode picked for you to within 2 ticks. The monthly chart would now require a monthly close above 334.70 to negate the existing sell signal. And if you look at the Huey weekly chart, it's in the same position as the weekly gold chart. It returned an inside bar last week, which tells us nothing more about the market. It doesn't add to our knowledge in any way, other than to say that there is a loss of momentum. And the weekly Huey chart requires a close above 226.90. A weekly close above that number to negate the existing sell signal. So we still have monthly and weekly, the longer term sell signals in force for gold and Huey, and they're all on a sell. So that's our primary focus. Our next chart to look at is the daily chart of COMEX Gold with the Daniel numbers on it. And you'll recall last week we talked about the key reversal bar that came off our TO3 buy signal. And you'll see now that that bar continued up until it came to the first Danielcode retracement on the chart, which was 776.70. That's the 37.5% retracement, which is a base Danielcode retracement ratio that markets use all the time, and the market went about 2 points through that, made a fast intraday reversal. That set up a late TO3 sell signal. Now, some of these TO3 buy and sell signals come in a better form than others. I generally say that once the turn has been made, much of the value has been sucked out. So when we see an intraday turn like that, it means that most of the value has already been claimed by intraday traders. But I put out the sell signal anyway, just to alert people if they hadn't already closed out their long trade. They should have. But 375, you can see on the chart, was a number at which you would have been paying great concern as a target, and certainly tightening up your stops and being prepared for a reversal there. And that in fact is what happened, and it issued a TO3 sell signal which was elected the next day. If we move on to the next chart, we now look at a same chart, COMEX Gold Daily, but I've now added the fast stochastic. If you look at our Learn to Trade videos, you'll see the process we build up, by which we start with our daily chart. We put on the slow stochastic, we put on the fast stochastic, and we're looking for both of these stochastics to be overbought or oversold to trigger a DC, a Danielcode reversal signal. And they're separate things. Sometimes the TO3s will occur at the same time as Danielcode trading signals. Sometimes they'll occur without a Danielcode signal. The important thing for those of you who are following the TO3 signals is to remember that they are not exhaustive. In other words, they are posted when the algorithm shows a setup, but you can't use them as a complete trading model. You can't, for example, buy on a TO3 signal and wait for, buy on a TO3 buy signal and wait for the next sell signal. It doesn't work like that. There may be a sell signal issued at the high, or there may not be, but what we rely on is you're managing your stops, moving your stops to protect profits, culminating that trade, and then waiting for the next signal to eventuate. But they are unlikely to be a continuous trading methodology. When we look now at our 240-minute chart, at our daily chart of COMEX Gold still, I put the two stochastics on there, and you can see at that low that gave us the intraday reversal for the TO3 buy signal, both of those oscillators were very oversold. So that was the alert for you to be aware that there was a probability of a Danielcode reversal there, and you had the Danielcode number at 681.40, and of course that stopped the market like a train, and it duly spun and turned at that market. If we now look at the 240-minute chart, for those of you who are a bit more active traders and want to get into these trades at an early position, you can see now that we put up the 240-minute chart. You can see that at the low, the slow oscillator was very oversold, and as we rallied up off there, you could have bought at the high of that first crossover, the first 240-minute chart bar that gave you a positive cross on either of the stochastics. In this case it came on the slow stochastic, the 14.3 stochastic, and then off it went, and it rallied all the way up to the Danielcode first target at 776. At that stage you should be able to see that both of the oscillators are now very overbought. The fast and the slow, they're both very overbought. We're at a Danielcode number that is telling you, at least on this short-term chart, that there is likely to be a reversal there. And you will see from the crossovers that you could have entered that sell trade from the TO3 signal considerably earlier than the daily chart allowed you to enter. The next chart, very briefly, something I just wanted to put in front of you, was the 720-minute chart. This is a very good technique for a slower form of trading for those of you that can handle something more than just a daily chart, but don't want to get down to spending hours in front of computer screens watching 240-minute charts or shorter. It's a lazy man's way of trading, but it's one I use, and I found it very, very effective. And what we do is we use a 720-minute chart. That is, we simply divide the day into two equal sections. You'll see from that chart with the oscillator on it that there was a better entry on the buy signal and a very much better entry on the sell signal. The next two charts we just look at briefly are the daily charts of silver, followed by the daily chart of the Huey. On the silver you can see that from the last sell signal that came late last week, silver took that signal as well as a way of confirmation of the gold signal, but immediately reversed. It was clear that there was not a lot of downside momentum. Huey, you'll see, did not elect the signal at all. So with the latest sell signal in gold, it's been quite muted so far. It may have more legs to go, we don't know yet, but what we do know is at the time it was elected, the Huey chart failed to confirm it, and that was the warning for us to at least tighten our stops and be prepared for it to not be a great trade. Now, we never know these things in advance. It's a question of waiting for the market to show us what it has, and for that we use our trading protocols, particularly our risk management, with our stops. So in summary, we have gold still on its monthly sell signal, still on its weekly sell signal, same in the Huey, no indications yet of any strong buy signals. The daily charts will tell the story, but I suggest to you that for the next couple of days it's a time to be very cautious in the markets.